Hi everyone. Today's discussion is on trade receivables finance. Because of the ever increasing trend towards the provision of buyer's credit, it is important for businesses to evaluate and understand different modes of financing against trade receivables. Today, we'll be exploring three key modes of financing trade receivables. The first one is factoring, the second is bill discounting, and the third is loan against invoices. So let us start this tale of three modalities of trade receivables financing. So let's start with factoring. Factoring is a financial transaction where a business sells its accounts receivables to a third party, known as a factor, at a discount. The factor then collects the payments from the customers. So let's see how factoring works with the help of these six steps. Step 1. A business sells goods or services on credit and draws an invoice on the buyer. The business then takes this invoice and goes to a factor and sells the invoice to this factor. The factor will advance a portion of the invoice value to the seller. Thereafter, on the due date, it is the factor which collects the payments from the customer, from the buyer, that is. Factoring can be of two types. The first is recourse factoring. In recourse factoring, the business retains the risk of non-payment by the customer. That is, if the customer doesn't pay, the business must pay back the unpaid invoice. In case of non-recourse factoring, however, the factor assumes the risk of non-payment. That is, if the customer doesn't pay, the factoring company absorbs the loss. Now, there can be certain benefits as well as drawbacks of factoring. In terms of benefits, factoring can help businesses with immediate cash flow. There is also an outsourcing of collection. That is, it is no longer the headache of businesses to collect payments on the due date from its customers. It is the factor which collects the invoice amount. In terms of drawback, factoring can have a possible impact on customer relationship. That is, if the factor's collection methods are too aggressive, it can have a negative impact on the relationship the business has with its customers. The second mode that we'll discuss today is bill discounting. Bill discounting is a financial service where a business sells its bills of exchange to a bank or a financial institution at a discount before the bill's maturity date. So, similar to factoring, bill discounting also provides businesses with quick access to cash. In terms of drawback, in case of bill discounting, the business will be liable to pay if the customer fails to pay. This is different from non-recourse factoring, where the factor will not have a recourse on the businesses even if the customer fails to pay on the due date. The third mode that we'll discuss today is loan against invoice. Loan against invoice, also known as invoice financing or invoice discounting, involve using outstanding invoices as collateral to secure a short-term loan from a bank or a financial institution. In case of loan against invoice, unlike factoring, the business retains control over customer relationship, since it is the business which continues to collect payments. One more important concept that is important for us to discuss here is revolving line of credit. Sometimes lenders sanction a line of credit, that is to say, maximum amount up to which withdrawals can be made by showing the invoices. This line of credit gets reinstated every time there is a repayment by the borrower. This takes the form of a revolving line of credit. This image of a water wheel that you see represents a revolving line of credit in my view. Revolving line of credit, although takes away the burden of going through the entire credit assessment process every time the borrower requests for a disbursement, there are also some disadvantages. Firstly, the in case the revolving that is in case the revolving line of credit advanced falls under the definition of digital lending and it is covered by the digital lending guidelines, the DLG or the default loss guarantee guidelines or the recently issued FAQs on the default loss guarantee prohibit any kind of DLG support on revolving lines of credit. Secondly, such loans pertaining to revolving credits can neither be securitized under the SSA directions nor they can be transferred under the transfer of loan exposure directions. In this context, it is also important for us to understand and discuss the options available with the lending institutions once they have advanced credit against such invoices or bills of exchange. So the first question is, can a financial institution that has accepted receivables in a factoring arrangement subsequently transferred these to another financial institution? Let's discuss the situation under factoring first. Factoring involves, as discussed previously, factoring involves a financial institution registered as a factor with the RBI, purchasing a business's accounts receivables and advancing money against them. Under the TLE directions, that is transfer of loan exposure directions issued by RBI, receivables acquired as a part of factoring business can indeed be transferred to another financial institution. Now, the question may arise that how will the minimum holding period requirements be fulfilled? So, generally, the TLE directions mandate a minimum holding period requirement for loans. That is a minimum period for the loans to stay in the books of the originating financial institution. For loans with tenure of 2 years or less, the period is 3 months. So, due to the short tenure of trade receivables, fulfilling this minimum holding period requirement can be challenging, right? So, in this regard, the TLE directions provide an exemption from the MHP requirement for receivables acquired as a part of factoring business. According to paragraph 39 of the TLE directions, in case the residual maturity of receivables at the time of transfer does not exceed 90 days and the transferee conducts proper credit appraisal of the drawing of the bill before acquiring such receivables, then there is an exemption from the minimum holding period requirement. So, two conditions need to be satisfied. The first, the residual maturity of the receivables at the time of transfer should not exceed 90 days. Secondly, the transferee must conduct proper credit appraisal of the drawing of the bill before acquiring such receivables. So, in case these two conditions are satisfied, they can indeed be transferred under the TLE directions. Now, let's examine the transferability of discounted bills of exchange. Bill discounting involves a financial institution purchasing a bill of exchange from a business before its maturity date at a discount. The transfer of bills discounted bills of exchange will be governed by the Negotiable Instruments Act and not the TLE directions. Third modality that we discussed today is loan against invoice. Loan against invoice is similar to any secured loan provided by a financial institution. So these loans, the transferability of these loans fall under the purview of TLE directions, and they follow the same rules and requirements as any other secured loan. Now, let's discuss the securitization of trade receivables purchased from borrowers. So, in terms of para 6 of the SSA directions, Trade receivables with tenure up to 12 months purchased by lenders from their borrowers will be eligible for securitization, provided the drawee of the bill has fully repaid the entire amount of the last two loans or receivables within 90 days of the due date. So, in case if and only if the drawee of the bill has repaid the entire amount of the last two loans or receivables within 90 days of the due date, and the tenure of the trade receivables is up to 12 months, they will be governed by para 6 of the SSA directions and will be eligible for securitization. So, to summarize, we have discussed three modes of trade receivables financing. The modes were factoring, bill discounting, and loan against invoice. Each method has its own benefits and drawbacks. We have also discussed what options the lending institutions have after they have advanced credit against invoices or bills of exchange. So, thank you for listening to this tale of three modalities of trade receivables finance.